Begrüßen Sie mit mir gemeinsam Erick Muller von Muzinich.
Hello.
Welcome.
Thank you.
Er ist seit 2015 bei Muzinich und verantwortet dort unter anderem den Makro- und Rentenmarktstrategie. Sein Thema ist heute Income is back, enjoy it. Das ist eine sehr, sehr klare Aussage. Ja, Mr. Muller, the floor is yours.
Danke sehr, danke sehr. Ein französischer Staatsbürger zu sein, aber in London zu leben, arbeiten für ein amerikanisches Unternehmen an heute in Deutschland zu präsentieren, wird mich daran hindern, einen Eröffnungswitz über die Fußball-World Cup zu machen. Es tut mir leid, dass ich auf Englisch wechseln muss, aber ich habe meine Deutschkenntnisse erschöpft. So basically, I've exhausted all my German capabilities now, and I will switch to English. Muzinich is, let's start with the boring part, and let's try to have the interesting part after that. But let me present what Muzinich is. Muzinich is a family-owned and independent company that is dealing with corporate bond market globally. It's a research-intensive investment process with people based in New York, in London, and in Asia. It's an American company. The founder is American citizen. The headquarters is in New York. But 90% of our business is done with European client. So we know more about what the European clients are willing to get than anywhere else in the world. It's a large enough company with more than 30 billion under management. It was a bit more than 40 billion at the beginning of the year, but with market valuations and some outflows, the amount have diminished. It's a small company, but it's big enough to have very rigorous process, and I would say also it's a very well-reputed boutique manager. And that is important because it gives us access to the largest trading platform in the best conditions. Now, let's discuss about the markets. And here what we have is the evolution of total return of high-yield markets over the years. Today, or at 17th of November, we were minus 11.3% on the high yield in the US and minus 12 in Europe. This is not a very bad result. We've seen that before. This is not a catastrophic, but it's a very painful year. And for most of us, we have not seen such a painful year for almost 2 decades. Now, the good news here is that usually it is followed by very positive year, because once we are in this very negative mood, we tend usually to price a lot of bad news. And this is what I would like to discuss with you a minute. This is the evolution of total return for investment grade and high yield, but split by rating quality. So AAA being the best, CCC being the worst, and we make a distinction between investment grade and high yield. And of course, there is one thing that is striking here, is the duration, because I also split by bucket of duration, from very short duration on the left side and longer duration on the right side of each table. And the pain was duration, very much about that. Rates explain 2/3 of the negative performance this year. 2/3 of the problem came from this transition from very negative real interest rates into positive interest rates. I'll come back on that in a second. When I check the same thing in excess return, which means I try to remove the influence of interest rates, government bonds, Bund, T-bonds, etc.
I tried to remove.
Sorry, Siri, stop up. Each time I speak about treasury bonds, it makes the same thing. So if I look at only excess return, which is just the credit component of the return, it demonstrates that the credit quality in the high yield side was very much also affected. But in the investment grade side, it was still a story about duration. So basically, I take something from that. What I'm saying is that the credit market has already reacted to a lot of bad news. So we have to see now where additional bad news would come from to understand if the market is now ready for quite a significant recovery next year, or if we have further pain to wait for next year. The last few days are pretty interesting in that respect, because what we have seen in the last few days is a pretty significant rally in all risky assets with inflows into credit markets. And this is things that we have not seen so far this year. We've seen inflows in equity, beginning of the year, end of the first quarter, doubling down on when the equity market was down, doubling down on equity, but always outflows from the credit market from the 1st of January to the end of October. And November is slightly different, and we have to speak about that. Why it is different? Well, there is one message that I would like to convey today, is that the central bank had to surprise the market. It was necessary to create a shock and to explain what was happening, i.e. this transition from a very accommodative monetary policy to a more restrictive monetary policy. But what does that mean, restrictive policy? You have to go to neutral rates that is higher. But the question is, if you go like that and you converge from the bottom, or if you converge from the top. And if you converge from the top to neutral policy, it means you have to be in restrictive territory first, and then you accommodate a bit more. And that has an implication for central banks, is that you have to convince the market that you're serious about it, especially if you have made mistakes before. And this is exactly what happened in 21, where the central banks were too slow to react, too slow to raise interest rates. What we think today is that the central banks have stopped to surprise the market. They've done the job. They've moved the forward curve very much on the upside, as you can see on the top right. They moved the expectation of market towards what they think is a good terminal rate, where they're going to stop to tighten. This is done now. And that is, for me, the good news that we have to keep in mind for 2023. The other part of the analysis is about the rest of the curve, not only the short end, but also the long end. And this is where we think that the story is not finished. Because what matters today is real rates, and after real rates, or real rates, are not something that you trade every single day. You trade nominal rates. But nominal rates minus inflation expectations is real rate. So one important thing is to ensure that the inflation component is under control. Inflation expectation must be anchored. Each time the linkers market will show that there is a de-anchoring of inflation expectation, then the central banks will have to talk hard again and again. For now, the good news is that it is more or less stable in terms of inflation expectation. But story is not finished, the jury is still out, and we have to see inflation numbers really going down. Now, keep in mind, inflation will go down in 23. This is mechanical. You won't have the same shock in energy prices twice in the year. So, by construction, inflation will go down. What is important is the speed at which inflation will go down. And this is where we tend to be less optimistic than the market. We believe that there are a bit of risk that the inflation goes slower. And this is in particular in Europe, because the wage formation in Europe is slower. You know, when you negotiate the wages, it takes a bit of time. IG Metall has negotiated recently, but it will negotiate again in beginning of 24. So it takes time in Europe. It's much more instantaneous in the US. So what we think is that it will take a bit of time for inflation to go down. And I think Mr. Fischer was saying a similar thing some minutes ago. In the meantime, the market are willing to price a pivot. The inversion of the yield curve, so this is the 10-year minus the 2-year yield, inversion of the yield curve and flatter German curve, for instance, is the indication that the market is willing to see good news. We don't like to be too pessimistic. We want to be optimistic. So we expect the Fed and the ECB to pivot next year, to stop raising interest rates, and potentially to start cutting interest rates. That is where we are less positive on that. It has one conclusion. It is that the long end of the curve will continue to be very volatile, because we'll go through a phase where we are very optimistic, like now, where yields are moving down again, and we'll be disappointed, and yield will move again, and then we'll want to be optimistic again, etc., etc. So the volatility is here to stay, especially at a moment where the central bank will have to reduce their balance sheet. So this is a very important conclusion from our allocation mindset, because we would like the long end, but we need more visibility on inflation that we won't have. So that's why we prefer the short end, and I will come back on that. Another angle is the spreads, credit spreads, and the yields that are available right now. So what we believed a month and a half ago, was that the market has been pretty negative this year on spreads, expecting some slowdown in growth and therefore being afraid of default. When you enter into a period where a recession is coming, the only thing that you fear really is default on your portfolio. And the market has been quite negative in the second half of the year and beginning of in the second quarter of the year and the beginning of the third quarter about this default cycle. We're not sharing this view. We're slightly more optimistic. All the companies have actually exited from COVID period with a lot of defense, a relatively strong balance sheet, at least on the high yield side. Leverage has come down. There's a lot of cash on the balance sheet, and they could not issue bonds this year, so they've been extremely cautious in the way they manage the balance sheet. And for us, it means that they are not prepared completely, because we never know the severity of a recession. We know when it starts, we don't know when it stops, and how low you can fall. But at least they had enough time to prepare themselves for this period of difficulties. And another observation is that when you have very large default, it's usually because the energy sector is defaulting a lot. It's 15% of the high yield market in the US, for instance. And this time, the energy sector will not default the same way. So I think in terms of fundamentals, that's pretty okay for us. And that's why we see value on the credit spreads for 2023. The second aspect is the yield. And with the rise in yield we've seen in 22, we see now a very different type of allocation framework. Cash is an alternative. Cash is not expensive. Cash brings more money. With higher short rates, you have a place to hide when everything is wrong. And that was not the case before. Yields, you had very low yields at the beginning of the year. Very low yields, very low spreads. Investment grade, 0.4% yield in the beginning of January 2022. Today we are speaking about a 4% yield. This is completely different environment. You are being protected by the level of yield against potential underperformance. You were, sorry to say that, completely naked at the beginning of the year, with no protection at all. That is changing the way the money is being allocated. Another aspect is vis-à-vis the equity market. Dividend yield in the equity market, 2.5%, compared with 4% investment grade, or 4.5% in the US. It's a complete different term of trade for asset allocation. So when you enter into 2023, you cannot enter the same way you entered 2022. 22, you are overweight equity. This is the only things to do. Overweight equity financed by a massive underweight in fixed income. 23, you will normalize your equity allocation to probably market weight. You will reduce completely your underweight in fixed income. And within fixed income, very probably all allocators will overweight credit to govies. Because if there is a problem coming, it will be felt on the govie side much more than on the credit side. Now, when you're convinced that credit is an opportunity, you want to know, where should I go? And there is one thing that I look at very regularly, which is this chart. This chart shows you, for investment grade or high yield, the evolution over time of the spread versus the duration. So how much gain I have, potentially, for a unit of interest rates risk. What credit brings me versus the risk I'm taking on interest rates. And usually what I want to do is to capture the best value, the best ratio. So where the spread is the largest for one unit of risk. And this is today in Europe. And that is interesting because that was not the case before. But this ratio has moved by 118% between the average of 2017-29 to today. And it's a higher rise than everywhere else. And it's a higher rise in investment grade than in high yield. And that, I think, is important for your type of investments because you want to take a bit of risk, but not too much risk. And in our allocation today, we are recommending really investment-grade bonds. And in particular, European investment-grade bonds. For European investors, because of that, but also for US dollar-based investors. So you'll have friends elsewhere that will buy the same thing as you do. Think about that. I'm an Asian investor. I'm usually US dollar-based investor. If I want to buy euro credit investment grade, I would get something like, today, I checked the levels, 3.73% yield. But being a US dollar-based investor, I will hedge back into US dollar. And then, on a yearly basis, I have a bonus of 2.8%, which basically means that I have 6.53% yield if I am an Asian investor or a US-based investor. So everyone will want to benefit from this. We are European-based investor with the yield we can get, plus the foreign money that will come. So that's what we think and why we think that investment grade today is a good thing to do. So what we do on a monthly basis in Muzinich is to gather all the PM, and we try to have a reading of the markets and the macroeconomy through this FTVT system. F for fundamentals, T for technicals, V for valuations of the market, and the last T is tail risk, what is not expected and could hurt. So I leave you reading that. Of course, I will not go through each of them. But what we see is that the fundamentals are weak. It's not super good, but it's not too bad. And so we're quite okay right now. We don't think that the fundamentals will improve tomorrow, but they will not deteriorate much further. Good point. But still from a bad level. Technicals, absolutely critical. Technicals is new issue in markets, but also investors' demand. And as I told you, we've seen only outflows in 22. That will reverse in 23. The yield proposition is different. The equity proposition is different. The pain is there. So we'll see more inflows into credit markets in 2023. That is a certain prediction. How much is a question. How far is a question. But we'll see more inflows in 23. This is improving. Valuation, completely different story versus last year. I told you already. So it's a good level for valuation. Then tail risks, and we can discuss at length about the tail risk. But geopolitics is, of course, one. Sticky inflation and risk of monetary policy mistake is another one. And China, structurally lower growth is also a risk for global growth. Now, if we try to convert this into type of credit strategies that we would recommend, we see three objectives in the current situation. One objective is how to protect from the volatility in the market. How can I invest without being hurt? Second is, can I take advantage of this volatility? And third objective is, can I have a long-term vision of markets and try to look through what is happening right now and think about 3 years, 4 years, 5 years down the road and not the next 12 months. And here are a few credit strategies, credit solutions that we recommend. One is be global. Be global because the US cycle will start to desynchronize from the Euro cycle, desynchronize from the Chinese cycle, etc. So you may have an alpha capability in being able to move from one region to the other. We are not in a linear world. So that is something that we believe in. We like global credit strategy. The other point is we tend to like short duration because we believe in the volatility next year in the long end of the market. So we like short duration. It's the safest place to be. What we also like is mix in credit quality. Very top quality, too expensive. Nothing to gain. very poor quality, too risky in an environment where growth will be too small. But in the middle, what we call the triple B, double B part, when you manipulate credit rating, in the middle of that range, there is very good value. Almost no risk of default, unless there is a fraud, but almost no risk of default, and very good value in terms of yield. So this is where the value is. And finally, for those who are willing to exploit a bit more the yield market, but are, I would say, do not know when to enter the market, there are some strategies that are called long-short credit strategies that actually can be short, can be long. The portfolio manager will decide, but will help you to protect on the downside and to capture a large part of the upside. So what we think is we have three different strategies to propose. I don't want to push on the product, but happy to discuss that after the presentation at a break if you want. But just to give you a bit of an idea, in this particular type of strategy, it's a short duration, maximum 2 years, and we mix investment grade and high yield. Not too much high yield, a bit high yield, but enough to enhance the yield. And in euro term, at the end of October, in euro term, it was 5.73. It's slightly lower today because of market trend in November. But it's very generous. And it's a global fund hedged back into euro with more than 5% yield. Short duration means relatively low volatility. Another product is being tactical. Tactical means sometimes I'm very heavy in high yield, and then I can change very quickly and be very heavy in investment grade. The fund today has 25% treasury bonds. A year before it was zero, absolutely zero. So it actually means you want to be flexible here, flexible in credit, flexible in duration, and you leave the portfolio manager making these decisions. And what you want is to have a sort of average yield and performance in the year. So that would be this global tactical credit. I don't advertise too much the yield because this depends very much on the asset allocation. It's not a yield product. It's like the Jupiter product that you have heard about earlier today. It's being flexible, tactical, capturing opportunities. A third product is long-short credit yield. That's the name we give to this one. It's a product that buys high yield. Not investment grade, only high yield. But as I told you, high yield sometimes, it's interesting, 7% yield in European high yield, close to 9% yield in US high yield. So it's really attractive right now. But sometimes it's difficult to time the market. Sometimes it's too late, sometimes it's too early, and it can be painful if you got the wrong timing. So this product is offering a long and short. You have some long position, you have some short position, and you try to balance basically the equilibrium between the long and the short to ensure that you smooth the credit cycle over time and you really protect on the downside because of the short capabilities. It's tactical, but also it helps to get most of the upside, because if you withdraw your hedges, then you have all the upside of the market, which is, of course, an asset allocation decision, but if done properly, can be very rewarding. And over time, this product has behaved very well in the large shock that we had, for instance, in March 2020, when the market was down by 11%, this product was down by 2% only. So strong caution here. So that's the three types of strategies that could help you in this environment. One, short duration. I take a bit of risk, a bit of credit risk, but I know I'm paid for that. No big surprise, sleep well product. A second product, more tactical, more flexible, getting opportunities here or there, and with the capability to rotate the portfolio quite quickly. Third one, I like high yield. 7 to 9% is something I can't ignore anymore, but I'm afraid to have the wrong timing. And that will protect me from being too entry point sensitive, if I may say. Okay, so that's my conclusion. And thank you very much. I don't know if you have one or two questions that I could take. I would be happy to take them. If it is in German, I may understand them, or I may be completely wrong. But you can try.
So, Feuer frei. Clemens, hast du eine Frage? Hast keine? Gibt es hier denn Fragen? Einen Joker brauche ich.
No.
Danke, Herr Wittig. Sie retten mich zum zweiten Mal. Sie haben jetzt was gut. Bitte sehr. Danke.
How do you implement the short positions into your long short funds? Do you go over durations, negative durations, or how is this working into the fund?
Yeah. Okay, good question. No, we don't take negative duration in this product. We could. We've done that once, maybe, in very crisis time. But usually we reduce duration very close to zero when necessary. Credit duration and interest rates duration. Long-short credit yield is focusing on the high-yield market. So by definition, it's already 3 to 4 year duration. To give an example, when you go to investment grade, you go to 6 or 7 year duration. So you almost twice the risk in duration in investment grade. So already it reduces this risk with the investment universe this fund is actually investing in. On top of that, when you short credit, you're shorting duration by the instrument. So we use derivative instruments for that. CDX, iTrax, options, only long options, but you can be long put on iTrax or you can be long put on equity. Actually, that will reduce your duration synthetically. So we use the derivative markets very much in the third strategy to reduce this duration. And it's pretty liquid. The benefit of the derivative market is that it's quite liquid. So you don't have to rotate your long portfolio. In current times, liquidity is not always very good. So the derivative market is more liquid than the cash market. So the benefit is that it's a cheap cost to do that. Thank you for your question.